What's up, everyone? So in this video, I decided to interview my good friend and mortgage broker, Jacob Manishevitz from Safebridge Financial. And we really discuss two very important topics. Recently, as many of you are aware, the Bank of Canada increased its interest rate by 25 basis points. As well, in the news, there's been a lot of concern growing about mortgage fraud taking place here in Ontario. So I decided to have this interview catered towards those two topics, and we're going to be discussing that in a bit more detail. As well, I wanted to go over some of the questions and comments and emails that everyone has been sending that are mainly focused more on the mortgage side of the home buying process. So without further ado, please enjoy this video, and again, I hope it's informative, and if you like it, make sure to click on the link and subscribe, and I'll see you guys soon. Thanks. All right, so Jacob, thank you so much for joining me today. For people that are new to this channel, my name is Chris Chu, and I'm a real estate lawyer here in Toronto. And on this channel, I'm here to give you some useful tips, insights, and information into real estate law here in Ontario so that you can feel better prepared for your next real estate transaction. And with me today, I have the privilege of being joined by Jacob Manishevitz. He's a mortgage broker from Safebridge Financial. And today we're just going to have a little quick interview with him about some of the more pressing questions and concerns that I see a lot of clients and people on the channel sending messages about. So I thought it'd be a really good time to speak with Jacob, considering that yesterday we had just experienced another Bank of Canada rate hike. So without further ado, Jacob, thanks for joining us once again. And why don't you give us a little bit of an introduction about yourself?
Yeah, awesome stuff. Thanks, Chris. Thanks for having me. I'm really happy to be here. I'm excited to share my knowledge with your clients and a different client base as well. I'm going to talk about a lot of good stuff today, some first-time buyer stuff, some rate hike-oriented stuff. Just a little bit about me. Like Chris said, my name is Jacob Manishevitz. I'm a mortgage broker. I'm licensed in Ontario. I do a lot of work in the GTA. My office is at 401 and 404, and I live in Whitby with my wife and my baby. I do a lot of work from home. I do a lot of work virtually. And because I do work with a lot of first-time buyers, they're happy to do everything virtually with me as well. So if you're the kind of person that wants to meet at 8 p.m. in your pajamas on Zoom, happy to do that with you. No problem at all.
That's awesome. Now, thanks, Jacob. Now, quick question. How did you get started in the mortgage industry? And what made you kind of get inspired to do, get involved in the real estate business here in Ontario?
Yeah, it's a good question. Previous to mortgage brokering, I did some sales, and I learned that I like meeting new people. I like educating people as well. The biggest part of my business right now is the education piece. Like I said, I work with a lot of first-time buyers, and a lot of them are very hungry for knowledge. So spreading that education and seeing people become empowered and confident to take that first step, that next step into their home is really what brings me a lot of gratification in my business. But how I got into it was I was working a sales job. I wasn't really happy with where I was, and I wanted to look at the self-employed side of life. I wanted to get a little bit more flexibility into my professional life, looking towards, building a family and being a little bit more independent, having that flexibility in time, as well as being my own boss and being able to build my business that way. So I had a friend who did mortgages for a long time. He's now retired and does consulting, but he said, why don't you take a look at mortgages and get into I just fell into it. It was kind of where my path led me without me meaning to get there. And when I started, I fell in love with it immediately, just getting to guide people, educate people, and learn about, positively affect people's lives every day. That's my goal. That's kind of the pillars around which I built my business. So that's a little bit about how I got into it and why I enjoy what I do.
That's awesome. Thank you, Jacob. I totally agree. The education aspect and really bringing a lot of knowledge to clients and people that are just want to be informed. It's super enriching and it's super valuable. So I'm glad we share the same kind of values in that regard. So without further ado, let's kind of get into the questions here. For people that are, the uninitiated, but can you kind of briefly give us an explanation of what mortgage brokers do?
Yeah, absolutely. It's important to know, even if you think you already know, or like you said, somebody who's uninitiated and just getting into it. Essentially, a mortgage broker is somebody who brokers the transaction of a mortgage between the borrower and the lender. So, as somebody who's looking to buy a home and attain a mortgage, you need to find a lender that's going to lend this money to you in order for you to purchase the home, to help you purchase the home. And as a broker, my job is to broker that transaction. So most people think that, oh, I'm just going to go to my bank and see what they'll offer me for a mortgage. And so you go to the bank branch and you'll talk to somebody there and they'll say, here are your options and that kind of thing. But as a mortgage broker, and specifically an independent broker like myself, I have access to all of the lenders out there. So I work with the big banks and I work with a number of other lenders that most consumers haven't heard of just because they don't have regular street bank locations. They don't do this savings and checkings and investment accounts and that kind of thing. They focus solely on mortgages and they work with brokers like myself. So the advantage of working with somebody like me is that I've spent my years as a mortgage broker perfecting my knowledge about mortgages. I pride myself in my holistic approach to mortgages. So I'll take a look at your overall financial health and make sure that your mortgage is a complementary piece to your financial health, not just closing the transaction, not just getting you the best rate, which is what most people think that they're looking for, but really diving deep into the terms and policies of the mortgage and making sure that all of those match up with exactly what your goals are for yourself, for your future, for your family, for that specific property, and that kind of thing. So as a broker, I'm able to match you with the right lender for your specific circumstances. And my job is to learn about your situation and again, learn about your goals and make sure that your mortgage at the end of the day really lines up with your vision for your future.
That's awesome. Yeah, thank you for that. Now, I guess the next question then is for, a lot of people that are looking to purchase a home or are in the process and, maybe put in an offer to buy a home, when should they start speaking with a mortgage broker?
Yeah, it's a great question. Preparedness, as you definitely know and preach, is the most important thing. So I think speaking with a mortgage broker very early on in the process is very important. Even before you go looking for homes, even maybe before you get in touch with a realtor, knowing what your budget is going to be going forward and looking at homes in that appropriate budget range is definitely very important because you don't want to waste your time or waste a real estate agent's time looking at properties that are maybe above your price point, or maybe you can afford something a little bit more expensive than what you're actually looking for, but you weren't aware of that fact. And so getting in touch with a mortgage broker early, going through a pre-approval process or a pre-qualification process will help you to establish that budget, look at what your potential monthly payments might be and make sure you're comfortable with that, and sussing out any issues that might arise with your credit or your employment situation or something like that. So you can get those out of the way early and make sure that you're on the right path. And all the due diligence has been done up front so that you can go through a smooth offering process and eventual closing process.
Okay, awesome. Would you say like you have um, a certain months out before, let's say I'm just starting to think about buying a home. I'm just thinking about it. I'm not even, serious about it. Do you think that's like the ideal time to just start speaking with a mortgage broker, or is it, more precise in its timing? Like I'm going to see a few places a few weeks beforehand, or is it just the sooner the better, period?
I think the sooner the better. I don't think it's ever too early. I never turn clients away when they come to me and say, I'm looking to buy maybe in the next 2 years. Perfect. Let's take a look at your financial situation now. Take a look at what your earning potential is, within the next 6 months to a year to 2 years, and make sure you're set up for success. And I would emphasize, especially if you're self-employed, looking into the future from 2 years or even further is an important thing to do because then we can plan appropriately as far as your tax efficiency strategies versus how much a lender is going to lend you, A lending versus B lending, and that kind of thing. So I don't think it's ever too early. If you've just started a job and you're just starting to save for your down payment, that's great. Let's get in touch. Let's chat about what the potential is within the next few years for you.
Awesome. Now, I guess following up on that, and the whole, getting to know what a mortgage broker does and, uh, everything that's involved with a buyer kind of coming to you to speak with you, you know, what are the three kind of cornerstone qualities that you think people should be looking for when they're, trying to find a mortgage broker?
Yeah, that's a very good question. And I think it's something that you should look at with all of the professionals that you're using in this transaction. So make sure you're looking for these qualities in a realtor, looking for these qualities in a real estate lawyer as well. And I know you, Chris, are on the same page about this. My number one quality would definitely be accessibility. So you want to make sure that the professional that you're working with is always accessible. One of the downsides to, for example, going to your bank and working with someone at the bank is that they're probably only available between like 9:30 and 4:30 Monday to Friday. For somebody like
Mm.
myself, you can call me or email me anytime. I'm very responsive through email. I'll always pick up my phone. You have my cell phone number, so you can text me if you have a one-off question. And I think that's very important as well when it comes down to like the 11th hour when you're putting an offer in on a property. Maybe it's like 9 p.m. and your realtor is saying, can we go a little bit higher? You want to know if you can stretch your budget a little bit more for that specific property, increase your offer by $10,000 or $20,000. You can always get in touch with me in that moment and just say, hey, Jacob, can you run the numbers really quick for me? Make sure that I can afford a higher budget on this specific property if that's something that you want to do. So it's always bad when you're ready to offer on a property and you're very excited and then you can't get in touch with one of these professionals that is supposed to be supporting you through the transaction. So I would say accessibility is definitely number one. Number two would probably be the education piece, like I spoke about before. So you want to make sure that your professional is invested in educating you along the way, that's ready to hold your hand, especially if you're a first-time buyer, and has the knowledge base to answer all of these questions. Because as I'm sure is the same thing for you, I'm sure you get a ton of questions, and I'm sure you have clients coming
Yeah.
to you and say, oh, I'm sure that this is a stupid question, but blah, blah, blah. And it's like, no, there's no stupid questions. Like
Yep.
if this is your first time doing it, ask away, and I'm always here to support you through those moments of what you might think is a stupid question or a silly question. Being able to provide educational resources, again, as I'm sure you do, Chris, providing links to government websites about certain programs, providing other brochures and educational resources to make sure that you read up on everything that you need to know to be prepared for the transaction. And then I
Awesome.
think the third quality would be experience. You want to work with somebody who's experienced, somebody who works with a lot of clients who do condos, for example. As I'm sure in your case, you know the ins and outs of status certificates, which is very important to know as a real estate lawyer. You want to know, so you want to work with somebody who has that kind of experience. Myself, somebody who works with first-time buyers and knows the ins and out of the first-time buyer benefits and down payment qualification and all that kind of stuff. So working with a professional with experience, it may, may not need to be said, but I think it's definitely something that is important to look for as somebody who has those years of experience working with the type of client that you are, working with the type of property that you're looking for, etc.
No, it's totally true. And I think, to hammer home the point, like I never really thought about it much in terms of the availability until kind of you brought this up. But you're right, for a lot of banking professionals, and nothing against them too. I have nothing, nothing but good things to say about the people that I work with directly that are, working for the lenders at the banks themselves. But I never really thought about that office hours and the availability from a just typical 9 to 5 perspective. And I guess for brokers, it's true. If they're on the phone constantly, they're, dealing with different brokers. So the timetable is a lot different. It's a lot more open. And I feel too. So, I never even thought about that. And you're totally right in terms of the no stupid questions. I really do believe that, a lot of people are very shy. And they think just because Google has a lot of information out there that asking a question that to them may seem like it's obvious to a lot of people is stupid, but I really don't agree. I think that there's no such thing, or very limited circumstances at least, that there's stupid questions. So I really do agree that, having the courage to ask, and B, the someone to provide you with that answer in a kind of wholesome and, accommodating fashion is something that's very, very important.
Yeah,
Yeah.
absolutely. I would agree. Having that professional to be able, who has the boots on the ground every day, brings a lot more value than just, Googling a question, because you never know. Google is
Yeah.
great, but you never know if how accurate or how current, or if it's talking about Canadian rules versus US rules, or something like that. And going back to the accessibility piece, if you are, traditionally employed and work a 9 to 5 job, it may be hard for you to meet between the hours of 9 to 5, but having availability in the evening or on the weekends, that's very important to my clients as well.
Totally. Now, I guess the last question before we kind of get on to more substantive things is, for people that already do have homes or homeowners, and maybe have a mortgage, maybe maybe they don't, um, you know, maybe they're not even thinking of selling a place, right? But how often, if at all, should homeowners check in with a mortgage broker or their specific mortgage broker, and why, if there's, any specific reason to?
Yeah, that's a great question. I would say that the effort of connecting on a regular basis should come from the broker's side. So the broker should be connecting with you on an annual basis, maybe around your birthday, sending you a happy birthday email around the holidays saying happy holidays. Let's schedule an annual financial review to make sure, your mortgage is still aligned with your goals, with your financial situation. So I would say a yearly review is probably a smart way to go about it. At the very least, your broker should be getting in touch with you about 6 months before your renewal date. So if you go for, say, a 5-year term, your broker should be getting in touch with you in about 4.5 years to do a review, make sure that your upcoming renewal, everything is set up properly. And if there's any changes, so for example, maybe your goals have changed and you want to sell the property, your mortgage broker will definitely be able to advise you there. Maybe you're looking at buying an investment property, so maybe we should refinance your primary residence to help with the down payment for an investment property. There could be a situation where maybe you went through a life change and accumulated some debt. So let's look at a debt consolidation. Let's roll some of your credit card debt or line of credit debt into your mortgage. Or maybe we want to add a line of credit onto your property so that you can have an emergency fund or rainy day fund, or maybe again, consolidate some debt. So there's a lot of reasons to review your mortgage and review your overall financial situation. Coming from the borrower side, if there is a situation where maybe you did rack up quite a bit of debt over the last couple of years, or due to an unfortunate life circumstance or something like that, debt consolidation can be a great way to use your mortgage as a tool to help you turn things around in your financial well-being. So if something drastically happens to your credit or your debt owing or something like that, it may be a good idea to get in touch with your mortgage broker and just say, hey, this is the situation. How do you think we can go about it? Because as professionals, we're not there to shame you for bad habits or something terrible that happened to in your life. We're there to help you and make sure we can put something in place to rectify the situation. And if there is any other types of changes, or like if you can't make your mortgage payments, something happens, somebody loses a job and you can't make the payments, always get ahead of it. Always get in touch with your mortgage broker and say, hey, I missed my last payment. I'm not sure if I'm going to make my next one. What can we do? And there's always ways to renegotiate and kind of smooth it out a little bit. And because the last thing anybody wants to do is have to sell their house or go into foreclosure because they can't make their payments. And lenders usually can be very flexible around that kind of stuff if there is a reason for you not being able to make your payments. So again, if it gets to that situation, don't wait. Don't put it on the back burner. Get in touch with your mortgage professional because we can help. There's always going to be a solution. And the sooner we know about it, the better.
Awesome. That's great advice, honestly. And I'm sure, with the rate hikes and the drastic changes that have been going on for the past, I would think year now, it's only more important that people, regardless of, whether they're homeowners or if, they're experiencing good financial situations or, tough times, it's always good advice to check in with a broker. So thank you for that.
Yeah,
So let's kind of
absolutely.
move. Yeah. So let's kind of move into the next question. Now, this actually is a question that I get a lot from clients who have, signed a purchase agreement and are still in the process of either speaking with their mortgage broker to kind of nail down a specific lender, or more commonly where, they're actually just kind of still looking for a mortgage broker, and they hear about these different types of lenders, and they use, in Canada at least, or in Ontario, we use A lenders, Alt A, and B lenders, private or C lenders. Now, these are kind of terms that are more industry standard terms, I think, and when buyers first encounter these kind of like terms, they don't know what that means. So, I was hoping you can shed some light on what the difference of these different, letters of lenders are.
Yeah, of course. So A lenders is pretty straightforward. Any of the big banks can be considered an A lender, and a number of other lenders that I mentioned a little bit earlier that only work through the broker channel, so they only work with professionals like myself, and they still offer great rates and great service, a lot of the time better rates and better service than the big banks do. And again, that goes into kind of analyzing the different terms and policies between the lenders, which is something that I do all the time with my clients. But the thing to know about A lenders is basically they have the best rates out there. They're what's called prime rate lenders, or they lend with the best rates. So if you are an A plus client, for example, if you're a salaried employee and you have excellent credit, you're likely going to get qualified with an A lender. Not all the time, but that's a general situation. They offer a wide array of products. They do things like home equity lines of credit as well. So like I said, any of the big banks, and there's a number of other lenders out there. For example, First National is a good example. Credit unions can also be considered A lenders. So Meridian and Duca, they also do prime rate stuff. So A lenders, again, they're for the best borrowers. If you don't qualify with an A lender, doesn't mean you're not the best borrower. It's just they cater to typically employed people, traditionally employed people, and people with excellent credit.
Okay,
I put
awesome.
Alt A and B lenders, I put on the same bullet point there because they're very, very similar. Essentially, they cater to people who are either self-employed or have bruised credit. We call bruised credit or damaged credit. So if your credit score is below a certain point, the threshold is usually between 650 and 680. If you have a credit score below 650, then you're probably not going to be approved by an A lender unless there's somebody else on the file with you with a better credit score. But if the best credit score on the application is 650 or lower, you're probably going to have to go with a B lender. B lenders are great for self-employed people. So for people like yourself, Chris, and people like myself, B lenders cater to people to self-employed people who maybe they make good business revenue, but they are very tax efficient and they have low declared income, or maybe they've been in business for less than 2 years or something like that. You can still get a good mortgage with a B lender. Their rates are a little bit higher than A lenders, and there's usually a fee associated with a B lender as well. I grouped Alt A lenders in there because basically Alt A is just kind of the B section of A lenders. So the A lenders also have an Alt A division where they do closer to B lending. And a lot of times they're interchangeable. But again, the important thing about working with a mortgage broker is that I know the difference between the two and I can present the options to you and we can go through them together. So again, B lenders are for people with bruised credit or those who are self-employed and don't make as much on paper as they do in actuality.
Okay.
And then the third group we have here are private or C lenders. They're the same thing. Is usually revert to private lending. Some people call them C lenders, but basically private lending is one of two things. It's either an individual person who has a high net worth who is lending out their personal dollars to people who own properties and registering mortgages against those properties, or they're what are called mix or mortgage investment companies, where people pool their money together and then that money is lent out to individuals who are buying. And essentially, private lenders are the riskiest type of lenders. They have the highest fees and the highest rates. These days, you'd be looking at least 8 to 9% for a first mortgage, and that would be at like a very low loan to value. So if you had a high down payment, you'd still be looking at 8 to 9%. They also do second mortgages, which we'd be looking at like 12 to 13%. And private lending is very much for emergency type situations. It's rescue financing when all else fails, but you still want to keep the property. You would go for a private mortgage. People who do construction and who do flipping also go for private mortgages because it's always a short-term solution, usually 6 months, sometimes a year. And again, it's for somebody who's in a bit of a sticky spot. I don't do a lot of private mortgages just because, again, I do a lot of A lending with first-time buyers, but the option is there if you need it. It's not for everybody. And a lot of times it comes down to the borrower choosing whether they're going to sell their house or whether they're going to pay a very high rate mortgage with a private lender for a short term. But there always has to be an exit strategy. It can't be, I'm going to be a private client for life. You have to have a way to get out of the mortgage, because I would never want to put you in a private mortgage where it looks like you're going to be paying that for the foreseeable future. There always has to be a strategy for you to be able to upgrade to a B lender or sell the property in a short term or something like that.
Yeah, no, that's a man. I didn't even realize that it's gotten up to that high of an interest rate. Like, it makes sense. It's just it's been a while since I've even in my practice that we've dealt with private lenders, just because, when the interest rates were a lot lower, that wasn't really a concern for a lot of people to be looking at private lending. I do want to add too, that, again, with private lending, and you made this, you made this point, and I want to kind of allude to it a little bit more, is that, it's not just for, people that are in a bad, sticky situation. It's for people that, are using it as a short-term business goal too, right? So people that are using house flipping, or if, they need that money for an immediate transaction where funds can't be as readily available because of maybe the, with banks, with bigger banks and bigger lending institutions, there's a lot of bureaucracy or paperwork. That doesn't mean that there's no paperwork in C lending, or, in private lending. There's actually quite a bit more, but it's generally that they're more ready to disperse funds because it's not as, it's not as common to be accessed by a consistent group of people. So I feel like they're ready with that money a little bit earlier. But that being said, again, it is, it is a risky thing if you're just using it to buy a house, because that's, in my view at least, that seems like something that you should be kind of considering your credit, or whether or not that's an affordable, purchase. I don't know if you agree with that.
No, absolutely. If you're using it on a purchase, it should be a short-term solution. It should be you just helping you to close on the purchase. And like I said, there should be an exit strategy. But more to what you said about there is a place for private lending for people who aren't in a sticky situation. Like say you wanted to do an addition to your house, but you couldn't qualify for the line of credit or something like that. You can get a private second mortgage for $100,000, help you with that addition on the house, and then refinance with an A lender once the value of the house is increased because you've done that kind of work. So it can be good for renovations or home improvements as well, as long as it's a short-term solution. And like you said, as long as you can afford to make the payments.
Awesome. Thank you. So the next question we have, and this is a question, sorry, I just moved my chair and hopefully it didn't make it too big of a noise. But the next question that I get a lot of questions from clients, again, is what is a bridge loan? Now, I know what this term is, I know, and I can explain it, but, we have a mortgage broker here. So I think I'd, prefer you to help me explain what a bridge loan is. And following that, what is a trigger rate?
For sure. So I get asked about bridge loans quite often as well. And it's not quite as simple as most people think it is. Essentially, a bridge loan will help you bridge the gap between a sale and a purchase where the funds aren't ready to go for the closing on the following purchase. So for example, say you own a property, you're looking to sell that property and buy a new property. But the way you work out the deal with the person buying your current property is that they need to close by a certain date. And then the seller of the next property that you're purchasing also needs to close by a certain date, but there's a gap between those two dates. And essentially, you won't be reimbursed for the funds from the sale of your property in time for you to use those same funds to purchase the next property. So you need a loan to bridge that period. And the important thing to know here is that in most cases, the only lender that will provide you a bridge loan is the one that's going to have the mortgage in the end. So the one that's going to provide you the mortgage on that second property, on your upsize property, downsize property, whatever you're doing, that is the lender that's going to do the bridge loan for you. Because lenders, the fact is lenders don't make a lot of money off the bridge loan. They charge you usually a per diem interest rate. So you're paying like a few dollars a day basically to borrow this money, whether it's for 15 days, 30 days, 60 days, whatever the case is. They don't make very much money, and it's a very short-term kind of use of their funds. So they want to have the mortgage at the end. So say, you're going to have a mortgage with Scotia on the second property. Scotia is the one who's going to do the bridge loan for you. And essentially what you want to make sure is that there's enough equity between both properties that should the deals fall through, and that you are able to pay back the bridge loan. There's some calculations that go into it. It has to do with how much you're going to be selling the first property for, what the mortgage is on the first property, if there is a mortgage. You determine how much equity is available for them to register that bridge loan, and then they can bridge the gap for you. And basically, they send funds to Chris so that he can close on that property for you, and you can get rid of the bridge loan once those funds are paid off from the sale of the original property.
Yeah, that's a great explanation. A lot more mortgage technical, so I really appreciate that, because when I'm explaining it's just in legal terms. But for us, we only encounter bridge loans when it is when it's the situation that you are selling a property or selling your property to buy another property, and the uh, sale of your property comes after the purchase of your new one. Um, you know, essentially that's why you need that money to bridge it over, right? I will say, on a legal perspective, there's more paperwork to be done, because essentially we're not just handling, one mortgage, we're handling two. Essentially, like, the bridge loan itself is not necessarily a mortgage yet, but it is something that needs to be discharged and paid off. So there's a lot more that goes into doing a bridge loan. Um, do you see this commonly in the past, year or so, or is this kind of something that's been happening in previous years and more kind of profitable, economic times?
Yeah, I haven't seen it too much recently, to be honest. Probably just a couple times I facilitated it. And I think it comes with proper planning. You want to make sure that your closing dates line up accordingly so that the funds can be transferred over without requiring a bridge loan. It's not it's not expensive by any means. Like I said, it comes down to X dollars a day per diem that you have the bridge loan for. But for some people, it's an unnecessary solution, essentially. But no, I don't see it very often. But if it is a situation that anybody watching this video is in, or any of your clients are in, I'm happy to kind of walk them through it. But the thing to know is that the person doing the bridge loan, or the institution doing the bridge loan, is the institution that's going to be having the mortgage at the end of the day.
Yeah, awesome. And I guess speaking of, economic uncertainty and things like that, with all the rate hikes that have been going on this past year, a big term that's been thrown around is a trigger rate. You see it constantly on the news, mentioned in blogs and things like that. And, I wanted to, explaining these things to clients without kind of context on their specific situation is a little bit hard, right? But I think in a mortgage broker's, in a mortgage broker's words, what is a trigger rate, and why is this, such an important thing, especially right now with all the rate hikes?
For sure. It's a great question. And like you said, it's all over the place. So I get this question all the time. I have clients coming to me as well who I did their mortgage last year or 2 years ago, saying that my lender has contacted me and said that I'm hitting my trigger rate, or I'm about to hit my trigger rate. What do I do? So the first thing to understand is that a trigger rate only applies to those with a variable rate mortgage. And there are two types of variable rate mortgages. There's what's called an adjustable variable mortgage, and then there's a static payment variable mortgage. And the difference between the two is that with every mortgage payment you make, a portion of the mortgage goes to principal and a portion of the mortgage goes towards interest. And if you have an adjustable rate mortgage, the interest portion is going to increase as rates go up, and therefore the overall payment increases as well. The principal contribution stays the same. With a variable mortgage with the static payment, the overall payment doesn't change, but the portion that goes towards interest will increase, and then the portion that goes towards principal will decrease. So we've seen so many rate hikes over the last 10 months or so that people are getting to the point where their entire payment is going towards interest, and they're not making any contribution towards principal with every payment. So again, this only applies to people with variable rate mortgages with the static payment. Okay. Most of the big banks offer this. I think Scotia is the only one who has the adjustable rate variable, and most other big banks have the static payment, which is why a lot of people are encountering this. And so if you got a mortgage a year ago at prime minus 1%, and prime was 2.45, so your effective rate was 1.45%. 1.45, crazy, cheap, right? And now we're looking at 6.7 as prime rate, so prime minus 1 is going to be 5.7. So you went from 1.45% to 5.7% over the last 10 or 11 months with your interest rate, which means your payment has not changed, but the portion of your payment that goes towards interest has increased drastically. And chances are by this point, you are not making any contribution towards principal with your payment. That's not what the lender wants, because essentially you're going backwards in time. You're owing them more interest and you're not paying down any principal at all. And so what happens is your amortization on the mortgage, or the lifetime of the mortgage, is actually increasing, which is not what you want. You want to be paying down your mortgage. So again, you're going backwards in time, and the lender wants to make sure that this doesn't happen, because when your mortgage comes up for renewal, your balance owing on renewal could actually be higher than your initial mortgage balance, which again, nobody wants to be in that situation.
Yeah.
So what lenders are doing is they're coming to their clients and saying, look, you're about to hit your trigger rate, which is your entire payment going towards interest. And that you're usually, for most lenders, it's the fact that your balance has increased to the point where you're almost at your original balance and your balance is about to start increasing past the original balance amount. That's usually what the trigger rate is for most clients, or for most lenders rather. So what the lender is going to do is they're going to send you a letter in the mail, or they're going to send you an email saying that you're about to hit your trigger rate. Here are your options. And most lenders will provide the option of either manually increasing your payment. So you have the option to increase your payment by sometimes $300-400 a month. So that $300-400 goes towards principal. And again, you are starting to pay down the balance. Usually clients are not a fan of this option because they went with the static payment in the beginning so that their payment would not increase. And now the lender's telling them you have to increase your payment in order to continue on making contributions towards your principal. The second option is usually making a lump sum payment. So they say, look, you're going to have to put down $5,000, $7,000, something like that directly onto the principal so that you're continuing to pay down the balance of the mortgage. So usually the lenders give you a couple of options there. The other thing that I would recommend for those who are about to hit their trigger rate or who already have is like, let's look at moving to a different lender and locking into a fixed rate, something with a short term, like 2 years. At least you'll have the peace of mind of knowing that your payment is not going to change over the next 2 years. You're going for a fixed, which means, again, the payment's not going to fluctuate. It may be at a higher interest rate, but chances are it's going to be a comparable interest rate to what you're actually paying right now with your variable. If you're at prime -1, 5.7, you could probably find a 2-year fixed term around 5.7, 5.8%. So your payment would be about the same as what it is considering the most recent rate hike, but you would be locked in for 2 years. In 2 years from now, will rates be lower than they are today? Likely. No one can say for sure, but there's a good chance that it will be. And at that point, then we can look at locking in for a longer term fix, or if you want to go back to a variable or something like that, we can look at that as well. But really, you have to think about what matters to you. Is having peace of mind for the next 2 years, knowing your payment's not going to change, is that what's most important to you? Or are you okay to ride this wave? Maybe the most recent rate hike we saw is going to be the last one. If you believe that that's true, then maybe we can stay here and your payments will start coming down as rates start coming back down, or rather your principal portion will start coming back up as rates start to go back down and you're paying less interest with each payment. So in a nutshell, that's what a trigger rate is. It sucks when the bank lets you know that that's where you are, but there's things that you need to do to be proactive to make sure that you're not increasing the lifetime of your mortgage as opposed to decreasing it. And if you want to look at other fixed rate options with different lenders, I'm happy to get in touch and we can look at the options there as well.
Awesome. Yeah, it's good to know. And, it's a scary thought. I think a lot of people, when they were getting this, they weren't thinking about the trigger rate. Even when, we go over this with our clients, when we're making them sign the legal documents and making sure that the trigger rate's explained to them, it's, the rate hikes and how fast they've gone up is definitely something that's been a little bit scary. But, again, guys, if you're watching this, speak to Jacob or, your mortgage broker, and, they'll hopefully find a sense of comfort or give you a sense of comfort in finding solutions that are workable, and so that, there are options out there. So yeah, hopefully that's something that, will give you a little bit more comfort from watching this.
There's nothing worse than being stressed out and not knowing what's going on. At least get the education, know what your options are, and then you can make an informed decision from there. I always like to recommend things to my client. I never like to tell them what to do. It's always up to the clients to make their decision, but it's my job to provide the education to the point where they're comfortable with their decision, knowing what is going to happen and not being stressed out and panicking because they're not sure what the trigger rate means or if they have to do this because the lender's telling them to or whatever. So it's important that you get the right advice for sure.
Totally. And I really think, even when you're watching the news, it's so scary because, they only have, a 3-minute window to explain a very complex and very personal decision on your personal finances. So I think, even with that in mind, and even with a more expansive explanation like this in our interview, again, always, the point I like to hammer home to a lot of the viewers on the channel and to my clients is, speak to a professional, information is always great. It's always useful. But if you want advice, you need to seek out that individual professional on your own time to get that tailored advice. So, yeah.
100%. Absolutely agree.
Okay. So, another question we get from a lot of people, and I'll kind of premise this, is that, usually if one or more people are buying a property together, sometimes they're either going to be joined as co-signers or guarantor, or one person is the guarantor of the mortgage. Now, I was hoping that you could explain that a little bit more, because I think that people use these two terms interchangeably when they're actually a very different, legal consequences, but B, also on a mortgage perspective, qualifying and also the ultimate position of these two titles is very different. So, yeah.
Yeah, absolutely. I won't speak too much to the legal perspective of it because I know that's your area of expertise. But from a lending perspective, they are very different, and some people do use them interchangeably, like you just said, incorrectly. So first off, we'll say that co-signers and guarantors, there's a different level of involvement and liability that is involved with being one or the other on the mortgage. So the co-signer has a higher level of involvement and the guarantor has a lower level of involvement. And now I'll expand from there. Essentially, when you're a borrower, say you're a first-time buyer and you have a salary of X amount, and maybe you have a partner on the mortgage as well, and they have a salary of X amount, but it's just not getting you the budget that you want. One of the suggestions that I always give to my clients is let's look at bringing a co-signer on, because the co-signer's number one job from a mortgage perspective is to increase the approved mortgage amount. And the mortgage amount is based mostly on income. So if your income isn't at the level where it's going to get you the mortgage that you want, I always suggest when we look at bringing a co-signer on the mortgage, is that an option for you? Co-signers are usually parents. They have to be an immediate family member, but they're usually mom or dad. And a co-signer is somebody who brings income onto the file to help you get approved for a higher mortgage amount. The ideal co-signer is somebody who has strong income and not a lot of their own debts. So for example, if your parents are retired and they have a mortgage payment and a car payment, they may not be a good co-signer because their income is probably low because they're retired and they have their own liabilities as the mortgage payment or car payments or whatever. So not the greatest co-signer. But if your parents, say, are both still employed and they have a house, but the mortgage is totally paid off, that's probably a good co-signer because they bring good assets, good income, and not too many liabilities to the file. A co-signer is exactly like a co-applicant from a lending perspective as well, which means that we're going to look at their income, we're going to look at their assets, and we're going to look at their liabilities, and they're all going to be factored into the file. In all cases, a co-signer needs to be on the mortgage and on title of the property. So Chris is going to have to register them on title, just like they would with you as the main borrower, with your partner as the co-borrower. They're going to be basically at the same level of as you as far as having ownership in the property and having themselves on title and having a responsibility to help you pay them mortgage. If the mortgage cannot be paid, they're going to be hunted down by the lender in the same way that you would as the borrower or the co-borrower. Another thing to mention is that the co-signer will have the mortgage likely show up on their credit bureau. So if that co-signer is going to go out and try and get a new car, they're going to have that mortgage payment on their bureau when the car financing company looks up their credit. If they try and get their own mortgage, it's going to inhibit their ability to borrow as well. If they have another child that they're looking to co-sign for, it's going to negatively affect their ability to co-sign for the other child. So for the co-signer, it's very important to know what you're getting into. And essentially, it's like you're purchasing the house, just like the main borrower or the co-applicant. Now, as Chris can probably speak to, there are ways to arrange the percentage of ownership on the property when it's a co-signer. For example, you could do 50-50, you could do 99% and 1%. And usually the end goal in this is to help the person who's the first-time buyer maximize their first-time buyer benefits by getting 99% of it, and only 1% is the co-signer because the co-signer probably is not a first-time buyer themselves. But I won't speak any more to that because that's Chris's area of expertise. But this is what I recommend to my clients. If you're a first-time buyer, see if you can arrange it 99% and 1%. Talk to your lawyer about that and make sure they can do that for you so you can still maximize your first-time buyer benefits.
Yeah,
Now,
that's totally true. Oh, sorry, I didn't mean to interrupt you there,
no, not at
but yeah,
all.
you're totally right about that. Is that a lot of times when we get co-signers, it is usually because of the credit worthiness. I'm just assuming that as a off the bat, or they're not up to that limit yet before or that threshold, and then they have someone that's credit worthy to bolster that mortgage like borrowing power, I suppose. But the main thing too is with co-signers, like the big thing that we advise a lot of people that are co-signers is about the fact that it's used to also have an impact on your first time home buyer rebate if you are a first time home buyer. So it does impact, the tax rebate that you are offered if you're a first time home buyer, um, for your land transfer taxes here in Ontario and Toronto if you're in the city. So yeah.
Yeah, absolutely. And that's no small amount either. We're
No.
talking about almost $8,500 as a maximum rebated amount if you're purchasing within the city of Toronto. So it's important to know exactly what you're getting, what you're not going to have to pay at the end of the day, and what your ownership structure is as well. Definitely very important. I
Definitely.
will just add the detail that to distinguish between cosigner and guarantor, the cosigner, like the first bullet point on the slide there, adds income to the file, whereas the guarantor, which I'll talk about next, adds credit worthiness to the file. So
Sorry,
remember back when we
I
were talking,
mixed up and said credit.
yeah, no worries. So back when I was talking about credit score threshold 650 or 680, if you have bruised credit, or even if you have limited credit, say you were never a credit seeker, say you're younger, maybe in your early 20s, and you just got a credit card, you've got a low limit, like your limit is $1,500 or $2,000, and you don't use it very often, your credit bureau is going to reflect that you have a very shallow credit history or limited credit history. And lenders are wary about that kind of stuff because if you've never used a $1,500 limit credit card, how can we lend you hundreds of thousands of dollars and make sure that you're going to make those payments on time? It just, for them, it just doesn't add up. So in a case like that, either you have poor credit or you have limited credit, the lender may ask for a guarantor to come on file. Now, a guarantor is different than a cosigner because, again, it adds credit worthiness as opposed to income to the file. And you want to have somebody with strong credit. So you want to have probably, again, a parent who has had a mortgage, multiple mortgages, multiple car payments, maybe a student loan back in the day, and they paid everything on time, and they're a solid credit worthy person added to the file. So it gives the lender a little more peace of mind that, maybe you're going to get some coaching from your parents as to how to handle your credit properly if you don't have that experience. So a guarantor will add that credit boost to the file if your credit isn't at the level where the lender wants it to be to lend you the mortgage. In a lot of cases, the guarantor can be left off of title, so they don't have to have any ownership in the property. And in a lot of cases, the mortgage will not show up on the guarantor's credit bureau either, which means it doesn't inhibit their ability to borrow more elsewhere. So that's an important distinction, is that in most cases, and I will say in most cases, the lender does not require them to be on title and on the mortgage. Sometimes
Yep.
if the credit if your credit is like very bad, they will ask for the guarantor to be on title. And that's something that they will communicate to Chris in the instructions to make sure that he registers the ownership properly, depending on what the lender's preferences are. So that's basically the difference between the cosigner and the guarantor. The guarantor is less involved because they likely will not be on title. They do not have to have their assets and liabilities factored in. There's less paperwork that needs to be collected from them at the end of the day as well.
Awesome. Yeah, thank you. I can definitely say on a legal perspective, like you touched on all the things that I would have mentioned. For most guarantors, uh, they're not required, at least dependent on most of the uh, lenders that we've dealt with. They don't require them to be registered as owners on the property or on the mortgage. Sometimes it's just the mortgage, which is it's a very piece by piece and individual aspect. That's why when we advise clients of what those responsibilities are. But I think one of the really important things I want to add to that is that being a guarantor doesn't mean that you're not on the hook for the mortgage and not on the hook for paying it. The guarantor is essentially contracting to be the ultimate person that if the deal and the mortgage completely falls through and the borrower who is on title for the property is not going to cough up the money, is unable to pay, that they'll look to get it from the guarantor, because essentially they think that that person has the credit worthiness to guarantee the mortgage or guarantee its payment. So, it's not just because you are getting guarantor or you are a guarantor, it doesn't mean that you can just absolve your responsibility. It's not just a signing, like I'm just putting my name down on something. It does have legal consequences, and it is essentially an IOU that is taken very seriously, even if it's not being registered on any kind of property. So I guess this is the most important thing that, has come up in the news. And this is a very timely kind of interview that we had scheduled. I was hoping if you could shed some information on what's going on.
Yeah, absolutely. This is what everybody wants to hear about. This is what all my clients are talking to me about. How are these going to affect me? What does it mean? What should I do? So the first question is, how do they affect mortgage holders? So like Chris said, if you already own a home, you already have a mortgage, you're going to be affected by the rate hikes in one of two ways. If you have a variable mortgage, then you will be affected. If you have a fixed rate mortgage, then you're in the clear for now. You're not going to be affected. It's just when your mortgage comes up for renewal, we may be looking at a higher renewal rate if rates have not come back down by the time your mortgage comes up for renewal. That's for fixed rate borrowers. If you currently have a variable rate mortgage, like we discussed before, the two types of variable rates, the adjustable and then the static payment. If you have an adjustable rate mortgage, you're going to have seen your payment go up. So if you have an adjustable rate mortgage, this is old news. You've seen your payment go up 8 times now. So you're used to it. It's not a surprise. If you're a new borrower with a variable rate mortgage, you're going to see your payment go up. The rule of thumb is that for every $100,000 of mortgage that you are borrowing, you're going to see your payment go up about $15 per month per quarter point increase. So we saw a quarter point increase yesterday, which means that per $100,000, you're going to see about $15 go up in your payment on a monthly basis at a 25-year amortization. If you have a 30-year amortization, it's going to be slightly less, but I won't go into that. General rule of thumb calculation. If you are a borrower with a variable rate and a static payment, like we talked about before, you are going to be closer to your trigger rate if you haven't hit it already. So that's something to be concerned about as well. Your interest portion of your payment is going to be increasing and the principal therefore decreasing, and you may be closer to your trigger rate. That's how the rate hikes affect current borrowers. How a rate hike affects a potential borrower or a prospective home buyer is it's going to eat into your budget. If you are a prospective home buyer, you're going to be pre-approved or pre-qualified by your mortgage professional, and they're going to say, this is your budget based on rates today. We're going to put in a pre-approval for you. So you may have a rate hold right now with your pre-approval for 120 days, which means that they've locked in that rate for you. It's important to know whether your pre-approval is for a fixed rate or for a variable rate. Even if you're pre-approved and you have a rate hold on a variable rate, it's still going to go up because the way variable rates are measured is in relation to prime rate. So you'll see your variable rate, like we said before, at prime minus 1%, for example. Prime minus 1 is going to be prime minus 1 no matter where prime is. So your prime minus 1 right now is 25 basis points higher, or a quarter of a percentage point higher than it was 2 days ago. So it's important to know, even if you're pre-approved at prime minus 1, that prime minus 1 has gone up, regardless of whether you're pre-approved or not. If you're pre-approved for a fixed rate, then that specific actual rate, for example, 4.5% or 5%, is actually being held for you. And why this is important is because when you're qualified for the mortgage, according to the stress test, you're qualified at 2 percentage points higher than what you're actually going to be paying on the mortgage. So if your actual mortgage rate is 5%, you're being qualified like you're paying for a mortgage that's 7%, just to make sure that should rates go up, you can still make the payment. So that being said, every time there is a rate increase and rates go up, your qualification amount may go down because you're being qualified based on those rates. Long story short, make sure that you're in touch with your mortgage professional. As a mortgage professional, their job is to make sure they're keeping you in the loop if your budget changes at all based on any of these rates. So in a nutshell, as rates go up, your qualifying amount probably will go down. And it's important to know by how much And because it always depends on the property, depends on your income, depends on the term and the amortization of the mortgage, a lot of different factors. Again, your mortgage professional can guide you through that.
Right.
We'll move on to what influences rate hikes. So the Bank of Canada's #1 objective over the last 10 months has been to bring down inflation. And we are seeing inflation due to a number of factors. The prices of groceries going up, the prices of energy and gas going up. It has a lot to do with the conflict in Eastern Europe currently. It has a lot to do with the fact that Chinese shipping lines have been shut down for quite a while due to rolling waves of COVID in that part of the world. There are a lot of factors that have affected inflation. At the end of the day, inflation is not good for any consumer because our groceries cost more, our gas costs more, our general cost of living just goes up. And because that happens, workers then demand higher wages. And then the employers grant them the higher wages. And since then, these workers now have more money to spend on these costs of living like groceries and gas, those prices continue to go up. And this is what's called the wage price spiral. As wages go up, prices go up because people can afford more, and then prices go up so people demand higher wages, and it just keeps spiraling and spiraling. And so that's what's been causing a lot of our inflation recently. And what the government is trying to do is by increasing borrowing interest rates, bring down inflation. And how this works is that increasing rates essentially will de-incentivize economic activity. It'll stop businesses from borrowing money. It'll stop people from borrowing from their credit cards and lines of credit to buy more stuff because stuff is more expensive, and hopefully temper inflation and start to bring it down because borrowing money to buy more things is just more expensive because interest rates have gone up. What we've seen over the last few months is inflation rather trending in the right direction. We've seen it come down from 7.1 to 6.8 to 6.3 has been the most recent number for December. So it is coming down, it's trending in the right direction, and this is likely why we only saw a 1/4 point increase as opposed to 1/2 point or 3/4 points at the most recent Bank of Canada announcement. We've seen their rate hikes trending down because inflation has been trending down. Now, it's important to look at it not just at face value, and this is going on to the last point here, what's the current outlook? It's important to look at what the Bank of Canada is actually saying in their commentary as to their justification on the rate hike and to their outlook and what they expect to happen in the future. It's not just important to look at the amount that they hike. Oh, they hiked 50 basis points last time and now they hiked 25 basis points. So the logical next step is 0, right? That's not the best way to look at it. You have to see what their commentary and what the rhetoric is around the reasoning for the hike. And so what they said with the most recent hike is that because we've seen inflation trending in the right direction, we lowered the hike amount. We only went with a 1/4 point. And what they've said in a nutshell, but in a little more diplomatic way of saying things, is should inflation continue to trend down, they do not see the need for another rate hike in the future. Does that mean that the next announcement we won't see a hike? Not necessarily. Does that mean if inflation continues to trend down in January and February, will March 8th see a 0% rate hike? Likely, yes. If we see inflation plateau where it is now at above 6%, will we see a hike in March? It's definitely a possibility. So the moral of the story is nobody knows. The moral of the story is that we're looking at it on a month-by-month basis. And I think a lot of what affected their decision yesterday came from the December numbers. And I think a lot of what's going to affect their decision on March 8th is what we're going to see in January. February numbers won't be out by March 8th. So they'll only have January numbers to rely on. And if we don't see a continuing trend of inflation going down in January in a significant kind of way, like we're not talking like 0.1 or 0.2%, but we want to see a fairly large chunk of inflation brought down in January, then we can probably count on no rate hike in March. And if they hit the pause button, chances are we're going to see a pause for a significant period of time, probably at least 8 months, probably closer to 12 months before we start seeing any cuts happen. Because what people are looking for is cuts. We want to see rate cuts. We want to see interest rates go back down to 2% where they were during the pandemic. I don't think that's going to happen. I don't think we're ever going to see 2% interest rates again. I think that was a very unprecedented situation, just like what we're seeing now. And I think that a likely healthy rate zone is probably between 3.5% to 4%. So
Okay.
that's where the cuts will come down to. I think borrowing a mortgage at 3.5% and 4% is still a great deal. It's still a little bit above where the target inflation is, which is 2% to 2.5%. So if you're borrowing at 1% over inflation, still very cheap money. And I think that's what we should look forward to. Maybe not by the end of the year, maybe by early next year. But like I said, everything is going to be on a month by month basis going forward. And they're going to be very, very careful not to cut rates too soon, because if they do that, we could go back into another inflation spike. It's something we saw in the 70s and then recurred in the 80s. We saw an inflation spike in the 70s, so interest rates went up. They cut too early, and in the 80s, we saw an even higher spike in inflation, which is something that nobody wants to see. So what the Bank of Canada is trying to do is prevent that second spike from happening. Maybe we have some more pain in the short term to make sure that we have more longevity with a healthy economy and healthy borrowing environment.
Awesome. Yeah. To touch on that point too, about really low interest rates, you know, when I first started, the rates were, not as high as now, but they certainly weren't as low as, one. It was kind of at a mid, you know, 2 to 3, I believe, and that like maybe a little less. But I think a lot of people now that are really concerned are people that have had a very low interest rate, and have been very, very lucky to experience a low interest rate or have a low interest rate, either carried on from previous good times, but also we're seeing a younger group of home buyers and home purchasers that have never really seen anything other than a very low interest rate. So it is very shocking, not just to young people or to first time home buyers, but it is shocking to people that like my parents' generation, or our parents' generation for that matter, that have seen highs but have also seen lows. I think that it goes without saying that you only remember the best day of the your best day and not the worst days, right? So it does still affect a lot of people. And the last thing I really want to ask then is, for people that are homeowners and for potential buyers, is there anything that they can do to prepare themselves for another rate hike in the coming months, or just to kind of just overall in the next year to 2 years, just to prepare themselves so that they feel a little bit more relieved and prepared for any kind of downturn?
Yeah, for sure. It's a great question. So I would say the short-term answer to that question is somebody who is a new borrower and is afraid of even more rate hikes. It's a strategy that I've been employing with some of my clients on variable rates is, let's just get a pre-approval in at a fixed rate for you, a 3-year fixed or a 2-year fixed, for a switch, which means moving your mortgage from one lender to another without changing the amortization or the mortgage amount. So it's not a refinance, it's just a switch to a different lender. And what we can do is we can take you out of that variable rate and we can put you into a 2 or 3-year fixed rate. We can put a pre-approval in now, hold the rate for 120 days. We're going to get something in the low 5%, maybe high 4% range. And then if we do see another hike on March 8th, you've got this 2 or 3-year fixed rate in your back pocket. And then you can switch if you think that your situation is no longer viable because of the rate hike that we've seen on March 8th, or even the next rate announcement, because that'll still be within 120 days. So let's get that done for you. There's no obligation. There's a credit check. It's not going to affect your score unless you pull your credit at a whole bunch of different institutions. When you work with me, I pull your credit once and shop around to all the lenders, so it doesn't damage your score when I pull your credit, as long as we don't do it multiple times within a 30-day period. And let's just get that pre-approval done and put it in your back pocket. Then you have the peace of mind of knowing that in 2 months from now, in 4 months from now, you can make a quick decision to move to a different lender if you want to. There's going to be penalties to pay out your previous lender. There's going to be legal fees to switch your mortgage over to a new lender. but maybe that cost is worth the peace of mind that you're going to get by moving to a fixed. That's what I would say the short-term solution is. If we're looking at a 2 or 3 year horizon, likely rates will be lower than they are today. But if you're somebody who's borrowing today at 1.5% or 2% on a fixed, and your mortgage is coming up for renewal in 2 years or 1 year from now, mentally prepare yourself to have a much higher interest rate. That's what I would say. When
Yeah.
your lender contacts you, reaches out and says, here's your renewal, it's going to be 5.5%. At least you're expecting it. At least you're not going to be shocked when your mortgage payment is going to go up by $600 a month or something like that. And if we do have a year or we do have 2 years to prepare for it, at least we can be ready. And it's not a shock, and you don't have to make a last minute snap decision that may not be the best decision because it's more emotionally charged and it's more fueled by panic as opposed to properly prepared for.
Awesome. Thank you so much for that. Now, the last thing, and I know kind of this isn't on any of the kind of slides or questions that we preparing here, but one thing that has been in the news a lot here in Ontario is the recent amount of title fraud or mortgage fraud that has been going on in Ontario. Now, I'm not going to get into describing what mortgage fraud is in, this presentation. We're kind of running out of time for things, but I do want to ask on a broker's perspective, what are some of the things that, people who have mortgages, who are homeowners, can do to protect themselves against mortgage fraud, as well as any kind of potential, things that potential borrowers and future home buyers can do to protect themselves against kind of any fraud that may involve mortgage or real estate?
It's a great question, and it's an unfortunate situation that has been happening for a very small group of people, but everybody is susceptible to it to a certain extent. I'll say that the most susceptible people are those with free and clear homes. So if you have a home that doesn't have a mortgage on it, the ability for somebody to swoop in and sell that home from under your feet is much higher because they don't have to deal with any mortgages or any credit involved with that house. So essentially, it's just identity theft. And then they are selling that house out from under you by stealing your identity. So if you have a home that doesn't have a mortgage, I would recommend getting a home equity line of credit put on the property for $100,000, $200,000, whatever. You'll pay a small legal fee to have that home equity line of credit registered on the property. You never have to use it. You never have to put a balance on it if you don't want to, but at least having that charge registered on the property will be a hurdle for these identity thieves and mortgage fraudsters to have to overcome in order to sell that property out from underneath you. So the most susceptible homeowners are those without mortgages. So put a home equity line of credit on. It's a small legal fee, like I said, and you never have to use it. It could be an emergency fund or rainy day fund or whatever, but it helps to protect you.
Totally.
If you
I
do
do want
already
to.
have,
Oh,
sorry,
oh,
no,
sorry.
please go ahead.
I do want to add one thing to that point as well. And what I'm glad that you brought that up is that, a lot of people will just kind of willy-nilly say, hey, if your property doesn't have a mortgage on it, just put a line of credit or it's easy for, a lay person to just say that. It's different for a mortgage broker, a professional to actually recommend that because, there's a logic behind that, right? Even for lawyers, we have to be a little bit more careful about recommending that because we're not mortgage professionals. So I'm glad that you kind of have that in like perspective and a reasoning behind it. I will say though that there are legal, consequences because it is a debt, right? That's registered or a registered mortgage that's being, we call it a mortgage in most cases, regardless of the product itself. It's registered against the property. But in terms of how that protects against, potential fraudsters, that they can't simply, in most cases, just withdraw money or get another mortgage on the property, because usually a second mortgage or even a payout of some sort will require that first mortgage to be somewhat paid out or have evidence of that before they can get that money. The fraudsters can get the money and take it away. The one question I did want to follow up on is, even if they do put a home equity line of credit on to protect themselves against fraud, does that not affect their credit score in any way? Does it impact their credit score?
It doesn't impact the credit score in a negative way. You're
Okay.
essentially adding a credit facility to your credit bureau, which, if you were to borrow more things in the future, it would show the lender that you got approved for this credit line, which means that you must have good credit, that you are credit worthy in a certain way. Having different types of credit on your credit bureau, so that this would be a revolving credit facility similar to a credit card, because you can borrow from it and then pay it back kind of as you see fit, as opposed to an installment loan like a car loan or a mortgage where you're paying a certain amount every month until the balance is at
Mm,
zero and then the loan is gone. So it can help to diversify your credit. At the same time, if you do use it, it will add to your credit worthiness as well. It'll show that you're able to use a home equity line of credit with a limit of $200,000. If you can use that responsibly, that adds a ton of credit worthiness to your file. That shows another lender that, look, this person has $200,000 at their disposal and they didn't take it to Vegas and blow it all, or take a trip around the world and use it all, and then are struggling to make their minimum payments. So if you use it and you use it responsibly, it can definitely add to your credit worthiness. If you put it on there and you never use it, it's kind of like it doesn't do anything good or bad to the credit. It just kind of adds another credit line, and then it's not it doesn't take away from your credit score or anything like that. What I will recommend as well, though, and this would be my second point, is even if you do
mm,
have a mortgage or line of credit or anything like that, another step that you can actually take to prevent mortgage fraud is you can call Equifax and call TransUnion. They're the two credit bureau providers in Canada that most lenders use. And you put what's called a fraud warning on your credit bureau, which means that anytime anybody does a credit inquiry onto your credit, you will be called, like a phone call from Equifax or TransUnion, to confirm that this was you that did the credit inquiry. So sometimes I pull a credit bureau for a client, then I send it to a lender for a pre-approval, and then the lender says to me, there's a fraud warning on this bureau, so I have to confirm with the client verbally over the phone before we go any further. So that's another level of security that you can
mm.
establish on your credit, so that the credit providers, the Equifax or TransUnion, actually physically call you and say, hey, we just received a credit inquiry from Jacob at Safebridge. Do you know about this? And then they'll say, yes, of course, we're doing a mortgage pre-approval. And they'll say, okay, perfect. But if it's a fraudster trying to steal your identity and do something with the registering a charge on your property or selling the property, and you don't know about it, then they can put a stop to it right there as well.
Awesome. Yeah. Just one thing I think a lot of people they need to remember to pick up the phone from TransUnion and
Yes.
Equifax, and hopefully, not think it's spam.
Yep.
And B, know when they're actually having something that will initiate a credit check, right? Some people just think like, oh yeah, they forget about it, right? They're, oh, I'm gonna go and get a car loan, and they don't actually remember that, the lender actually needs to do a credit check. So if you are going to do the fraud prevention verification, I think that it's important that you remember that you're getting
Yeah.
hopefully remembering that you're getting a loan out of some sort.
Yeah, absolutely. I don't know 100% for sure, but I suspect that they may be also to send you an email if that's a
Yeah.
more viable form of communication for you. But yeah, I know most people don't pick up their phone these days, especially if it's a 1-800-1866 number, or from somebody like Equifax.
Yeah.
Yeah.
Awesome. Well, thank you so much, Jacob. Now, if anybody ever wants to reach out to you, hopefully they do. I'm really, hopefully some of our viewers are looking to get more information and want to reach out. Do you want to just, do a quick shout out, and I'll also pop your information and your contact details and stuff into the description below in the YouTube video. But if you want to just kind of give us a quick few places that, they can find you on social media or online.
Yeah, absolutely. So I'm on Instagram at Jacob Mortgage Matchmaker. My email, jacob@safebridgefinancial.com. My phone number, Chris, I'm sure you can put it in the description as well. But all of those forms of communication are good for me. Follow me on social media. I put out a ton of great educational stuff. If you want some free resources, first time buyer survival guide that I created, send me an email. I'm happy to flip that over to you. My website is yourmortgagematchmaker.ca. You can fill out an application online there. I have blog posts that go up there as well. So I'm in as many places as I possibly can be. And now I'm on YouTube. So this is great.
Awesome. Thank you so much, Jacob, and thank you so much for your time. I'm looking forward to speaking with you again and having you on the channel again. So until then, thanks.
Absolutely. Anytime, Chris. It was a pleasure, and thank you very much for having me.